And just like that, the market can turn. It's never a dull day in the market, with stocks coming off their highs on the back of some very grim earnings and policy changes. But had you watched yesterday's video, I flagged this already. I said stocks are likely to move lower into the end of the week, as my proprietary gamma levels were signaling a strong move lower in stocks, especially the S&P 500. So what comes next? Should you buy this dip, hold, or wait, especially as market breadth unwinds, as Walmart flagged some incredibly weak guidance for this year? Walmart is a fantastic barometer for the consumer and the economy, and we need to discuss what it means for stocks and the financial markets, along with some concerning charts that should have you on edge. So has the crash started, or is this the end of the road? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks pulled back as investors scrutinized Walmart's outlook and assessed the impact of Trump's planned tariffs and policy shifts. Now guys, it was a pretty brutal day, definitely rotation happening under the hood, although some of the big names really did help the S&P stay afloat. Nvidia, Apple, and Microsoft, number 1, 2, and 3 biggest companies in the S&P 500, were all up anywhere from 0.2 to 0.5%. That really did help the S&P 500 stay afloat. If these were flat to red, it would have been a very, very brutal day for the S&P 500, because you look at the rest of the semiconductor market, look at software as a whole, very, very red. Google and Meta were also red. Amazon and Tesla deep in the red as well. Walmart was down 6.2%, and that brought a lot of the growth consumer defensives down. However, we did see a rotation here into defensive assets, real estate assets, utility assets, healthcare assets, energy assets as well. So definitely a rotation happening under the hood from stuff like financials, pretty much the stuff that has performed really well. Walmart, Costco, Amazon, Google, software, this part here of infrastructure as a whole, into defensive assets. And the rotation is exemplified right here. Look at the top of the heap: real estate, healthcare, utilities was kind of flat today, energy as well at the top of the heap. And we saw a rotation into these names out of some of these names right here. Stuff like financials, discretionary, industrials, communication services as well. Now we saw staples under the hood. Staples was actually pretty positive if you remove Costco and Walmart, and I think equal weighted staples was positive on the day today, with the S&P 500 returning 0.42%. But it wasn't just large caps. We saw brutal price action across the board, mostly here in this growth component of the market. Small caps, mid cap, large cap growth all lost in excess of 1%, but we also saw selling, just across the board, with only mid cap value seeing positive momentum here today. A pretty ugly day, and again, it was all on the back of Walmart's earnings. Now, they actually beat quarterly profit, they beat EPS, beat revenue. However, 2026 fiscal year guidance was very, very cautious. Now, the reason why we actually did see a little bit of a comeback here is because the Walmart CEO went on CNBC and pretty much came out and eased investors' minds. He said they're conflating our guidance with maybe suggesting we're feeling things aren't good or that the economy is softer. Again, John David Rainey told Yahoo Finance this over the phone, but he said, let me be very clear, that is not the case. We feel really good about how we're doing and the economy. So I think this may have just been a little bit of a conservative guide, but the market doesn't want conservative guides, especially when you're priced to perfection, with Walmart trading at 40 times earnings. Nonetheless, I think Walmart is going to trade very trepidly over the next couple of months. And yeah, because of this, the stock market really did pull back. Walmart is a great barometer for the consumer. And when you're priced to perfection, any reason to sell, the market's going to take it. Now, another reason why the market sold today was Peter Hegseth came out and said that he wants the Pentagon to 8% from defense budget each for the next 5 years. And if you cut 8% compounded for the next 4 years, you're looking at a 43% defense spending cut over the next 5 years. So that's going to be very, very interesting to see if that is going to come to fruition. I mean, that would be tangible savings to the American taxpayer if that happens. However, the market doesn't really like this, and Wall Street is growing increasingly concerned that much of the positive news surrounding Trump's impending policies could already be priced in. And when you get something like this, right, disappointment, it leaves way more room to the downside than upside. And I think that really did affect sentiment. Now, it really did affect defense stocks. Palantir was down another 5% today after being down 11% yesterday, I believe. And yeah, it did bounce back off the lows right here, but that's still a pretty ugly day for the most part. However, there was some bright spots. Alibaba was up 8%. That's because he beat on earnings, beat on revenue, and revealed an aggressive push into AI. Very, very positive earnings. And I think this is going to really support Asian markets, Chinese markets as a whole. And then on the American side, Booking Holdings was up 2.1%, mostly here in the after hours. And that's because, again, it beat on EPS, beat on revenue, but increased its dividend from $8.75 to $9.60 per share. That's a pretty big increase in the dividend, and that's why we saw this move higher. There wasn't much in terms of data. Initial jobless claims missed ever so slightly. Philly Fed manufacturing missed ever so slightly, and we had a number of Fed speakers, but we kind of already know the rhetoric. They're all posturing the same thing. In other words, we're in wait and see mode. And then for everything we saw today, we actually did see inflows into the New York Stock Exchange. So that rotation happening under the hood definitely occurring if you're in the right names. And then we actually saw NASDAQ outflows with the S&P 500 being down 0.43% for the day. Now, we only had 2,400 advances, 3,800 decliners. Ugly day in the S&P 500 for market breadth. And we also did see shorter term and medium term averages lose their 50% mark with regards to their specific moving averages. Now, you do need to put this into perspective. We are 24 hours removed from an all-time high. So to say that we're on the cusp of a great rollover is a bit aggressive, but let's hop on the charts and see why I think this market is still poised to go higher, especially as we see pretty positive breadth here in the longer term averages. So you can clearly see a very ugly day for equities as a whole. The S&P 500 fell, so too did the NASDAQ 100, the Russell 2000, the RSP, mid caps and small caps across the board. Very ugly day. The after hours not looking that positive either. And this was on the back of yields actually falling. I think when it comes to spending cuts, yields are going to fall. The 2-year, 10-year, 30-year yield fell. The dollar fell as well. Very interesting. And then bonds actually acting as a hedge against equities for the most part. Both the AGG and TLT, shorter term and longer term bonds, gaining as a result. Bitcoin was up 1.56%. And then we did actually see a bit of the metals improve today. And again, that probably just has to do with some of the Trump policy, tariff policy going on under the hood there. And especially with some of the geopolitical tension we're seeing with Ukraine and Russia. So, the market's sort of using metals as a hedge. WTI up ever so slightly, and nat gas down 5% as well today. Very, very volatile. But yeah, equities looking very red. However, let's actually look at the structure of the candle here today in the S&P 500. It was actually very, very scary and grim at the lows of the day. However, we did actually par a lot of the losses we saw. If we just zoom in a little bit more, you can actually see something very interesting. We closed above the half of the candle, and that's often bullish. So we did have a red day. We did come off the highs, right? And this is exactly what I said would happen yesterday. We were at the core resistance. We didn't see the core resistance move up. That probably means we see downside. Now, the bulls did come in a very big way, and we did actually close at the open of yesterday's trade. So, I mean, if you look at from yesterday's open to today, we're actually net flat. However, still a red day, still an ugly day, and there's definitely that rotation happening under the hood. We definitely did see some defensive sectors outperform some of those more cyclical areas. But this wick is largely constructive if you're looking to buy the dip coming off the lows. However, I do think that we are going to see continued downside into the end of the week. I think we're definitely going to finish lower than what we did at yesterday's new all-time high. But again, like I said, guys, we are literally 24 hours removed from an all-time high, and we're still riding this momentum trade, and any type of volatility, any type of pullback, it's simply just a buying opportunity. Now, ultimately, I want to buy here at the 6,000 level. I do think we're going to finish anywhere from 6,600 to 7,000 to end the year. So I do view this as an accretive place to buy, especially for price appreciation, looking 12 months down the track. But you can't deny the fact that we definitely did see market breadth wane today, and that defensive rotation continued for the second day because we did see stuff like healthcare, staples, and real estate outperform stuff like tech for the most part. Now, looking at the NASDAQ 100, very similar situation. Things were looking very grim at the lows of the day. However, we actually finished in the top 1/3 year where the candle closed, still off all-time highs in the NASDAQ 100. Still looking very, very positive if you ask me, but the market just getting a little bit concerned. And when you're priced to perfection in stuff like the NASDAQ 100, you're going to get days like this where bears get very, very aggressive to start the day, and then bulls come in and buy the dip. However, this is your key line of support, right? If we actually move below this level right here, expect downside. And I am expecting probably downside into the weekend. I think with definitely some of the geopolitical tension going on, US and Russia talks, Ukraine not really participating, we can definitely get fireworks over the weekend. So I do think, especially with this geopolitical tension, we should continue to see a little bit of weakness to end the week and maybe some positivity here into the metals. But what we don't want to see, guys, is continued outperformance in these defensive sectors, because that is definitely Wall Street getting worried and concerned under the hood. Now, the RTY hasn't acted very, very well. It's actually in negative gamma, guys. And what does that mean? When we're in negative gamma and we close in negative gamma, we are going to target the 2200 area. Now, we don't actually consolidate here, the 2200 area. We're looking for an opportunity to buy the dip very, very quickly if we did get that. However, this is void if we go ahead and actually get back into positive gamma, and then we'll go from there. But yeah, RTY in negative gamma, that means 2200 is our target for now. So, the upside to 2325 has been voided. However, yields looking very constructive. I mean, we're at this 4.5% mark, and if we continue to move down, we could actually break these lows. The dollar was down in a very, very big way, and it looks like we've officially broken this area right here, this 107, this key critical area where we used it as support right here, made that move up, and then used it as resistance multiple times here. And then we made this next move up pretty much the 110 area. So we've broken this on what looks like a very, very strong candle, and do expect much of the same in the US dollar. I think we can target areas looking like this area right here, the bottom end of 105, and then we can target the bottom end of this range. So our next target is right here, this 105 area, and then from there, it looks like we probably target the 103 area in the DXY. I think this is going to be very supportive for equities for the most part, especially if we get to, very close to this 103, 102 area in the dollar. And generally speaking, this is actually what we saw in Trump's first term. About 3 months after the inauguration, we saw the dollar rip higher, and then we actually saw the dollar move lower into its first year, but still staying largely elevated, relatively speaking, to the other G20 countries. Now, guys, and this is why I've been a proponent of buying value names in the stock market for months. Look at the S&P 500 price to perfection. And this is why I say you definitely want to look at stocks like Evolution Gaming, right? Now, Evolution forming a very, very solid base right here. This is the cheap stock growing its earnings. This is definitely a value turnaround play. If you actually have a look at Evolution, right? Evolution is up about 10% in the last week. It was up 1.67% year to date. And I think we're at a very key level. Once we start breaking some of these very, very critical levels, I think we're going to see Evolution move a lot higher, and we're going to get to this $100 mark very, very quickly. We're at a very critical zone right here. Again, we've had a very, very solid and positive 10% move from these lows right here in the last couple of weeks. The stock is expected to grow earnings at about 12% for the next 5 years, earnings at about 15%. It's got zero debt, trades at 11 times earnings, and is the market leader. The only reason why it's pulled down over the last couple of months is because the UK Gambling Commission is doing a little bit of a probe into their business, but nothing should really compromise the market is mispricing it. Now, another name I do like, and probably one of the easiest doubles over the next couple of years, is PayPal. I view this as a great opportunity to get long right here. At these levels, it's trading at 14 times earnings. And I think we are going to see a little bit of churn over the next couple of quarters, but I do view the $77 area as a great opportunity to get long because we probably finish very close to the 104, 105 area to end 2026. Now, in terms of growth and somewhat of a value play, definitely Uber. This is definitely trading at a discount relative to its growth prospects. It's expected to grow earnings this year at 17% for the year, and it only trades at something like a 21 times EV to free cash flow, right? Which is a measure I look at a lot. That's very, very cheap. The S&P 500 trades at about a 24. So it's below the market multiple. I do think we have to consolidate some of the gains we see right here, but I do think this is a $100 stock at the end of the year. So guys, those are the individual names I'm looking at. And when you look at what some of these names have done, particularly stuff like Evolution and Uber, they've acted very, very well in the face of the S&P 500 seeing a little bit of volatility here today. And that's the type of stuff you want to see. So definitely take the opportunity if you're looking to index into your portfolio. Definitely want to look at any opportunities, buy those. But if you are looking for individual stock names, look at stuff like Evolution, right? Evolution is also a European company. Definitely broaden your horizons outside the US. I've said this for a while. The mid cap and small cap rotation is definitely underway. It's a longer duration trade. It's not going to happen in a month or a quarter. This is 12 months, 18 months and beyond. And we are starting to see it take shape. Look at something like the FEZ. This is the Euro Stocks 50 ETF, looking very, very solid. Yes, we have seen a little bit of volatility here, but we do have to consolidate what has been a pretty big run up. And you look at it year to date, right? Very, very solid returns. On a percentage return basis, that's a 13% move year to date for the FEZ, the 50 biggest stocks in Europe. So we're going to consolidate at this area, I reckon around this top end of the range, and then make the next move higher in European stocks, especially if we do get continued momentum in the Ukraine-Russia peace situation. That's very, very good for the market. We'll see how that pans out over the next couple of months. But for all intents and purposes, I'm still bullish and constructive on US equities. I think we see 6,600 and above in the S&P 500, but we do need to just digest some of the gains that we've had over the last couple of months. And that's actually what we've been doing for the most part right here. This is very, very healthy and very, very constructive for us to continue to move higher into the end of the year. Don't forget, third years of bull markets tend to be consolidation years, and then year 4 and 5 tend to be those years where we continue to see appreciation. So guys, take this opportunity to buy the dip. Be patient in 2025. We will go higher. It's just going to take some time. Now let's talk about the S&P 500 and its overall sector return compositions. And as we can see, this is year to date. The S&P 500 is up about 4%, a very strong start to the year. Now this is driven in large part by EPS growth as well as multiple expansion. Now I don't know why it's only 0.8%. I think what they're looking at here is EPS revisions to current estimates and then what the multiple does. So we are seeing mostly multiple growth in the S&P 500, but a lot of the earnings we should see is going to be back up, especially in the second, third, and fourth quarter of 2025. Sentiment by and large is still pretty neutral. We're sort of coming out of this fear zone. And even though we are at all-time highs, we haven't seen a push here into greed, into extreme greed territories, telling us that we are in a situation where we should already be positioned, we should already be long, and really in the third year of a bull market, the only thing you really need to do is just hold on to your gains, because what we see is generally just a stair step higher in the S&P 500. We have highs, we have lows, but we generally trend to the upside, consistently making new all-time highs. Now for 2025, we have made 3 all-time highs so far. In 2024, we made 57. And you can see that in bull markets, we generally continue to make new all-time highs. Yes, we do have some ups, we do have some downs. However, the general trend is to the upside. And we are still very early in this bull market, and we are still very early in the year. So do expect this to be a much bigger number towards the end of the year. Now, we just put in an all-time high in the month of February. And this is the S&P 500 performance 12 months after we've made an all-time high in February. Generally speaking, 12 months away from now, we can actually expect very robust returns. Average return, 14%. 19 up periods, 3 down periods. So very, very robust returns. And pretty much what you can see from the max drawdown here is that we tend to have either very shallow drawdowns, as you can see, or very, very sharp drawdowns regardless. So in other words, do be liquid, have capital ready to deploy if we do get something like this. Otherwise, if we don't, what we really should just see is the market to sort of stay at this all-time high level and for us to just continue the stair-step momentum higher, probably reaching the 6,800, 6,900, 7,000 level by the end of 2025. But in the year and now, this is exactly what February looks like. Now, the back half of February tends to give us an opportunity to buy. We actually tend to see downward price momentum, lower lows, lower highs, finishing slightly negative on average since 1950. And again, this should be viewed as an opportunity to get long because volatility is simply the price we pay for excess return in the market. We do have to be patient and endure the volatility, even the down days when we do get them. But we do have to pay attention to the big picture. The macro environment is looking very robust. If you actually look at global GDP forecasts, we're looking at 2.6, 2.8%, and Goldman Sachs US GDP forecast have actually seen some pretty upward revisions here. This is a Bloomberg consensus as well as the Goldman consensus, sitting at about 2.25 to 2.5%. This is expectations for this year. We've seen the Euro area's GDP move down significantly. Mainland China hasn't really done much of anything, but still elevated here at 4.5%. Definitely the place where you want to be still, guys, is the US market because Euro looking like a dumpster fire and China, can you really trust the numbers? The economy deep in recession. So best place to put your money, US assets. And if you can really find high quality growth operators, stuff like EVO, Evolution Gaming, right? Then I would invest in Europe, but very, very specific and very, very selective because there are a couple of tailwinds coming out of Europe, particularly pertaining to potentially peace deals as well as improving China for the most part. That's definitely going to help Europe. They say as China goes, so does Europe. Now, something else that's looking pretty good is actually the Redbook Index. This is sort of just like an aggregate of retail sales except done on a weekly basis. And we saw for this week an increase of about 6% in retail sales, very robust. And we've seen robust retail sales for the better part of the last year, well above the 4% range. And again, anything above 3% is pretty good. However, there are some risks to this market, guys, that we do need to be aware of. Break-even inflation rates, which reflect the market's inflation expectations, suggest that the fight against rising prices is far from over and will likely continue in the foreseeable future. And something that is a bit concerning is actually the CPI minus PPI. The spread is officially negative above the zero line. Basically, it's telling us that businesses and corporates are feeling the squeeze because they can't pass on the extra costs from inflation and input costs to consumers. This is really not good for corporate margins and could be a little bit of a headwind looking at S&P 500 corporates. The businesses that will come out on top this year, especially with this divergence we're seeing, is those with immense pricing power and B2B operators. Generally speaking, if you're selling to a massive business that's extremely wealthy with billions of dollars on their balance sheet or hundreds of millions of dollars on their balance sheet, they can absorb your price increases. But consumers can't. And this is what we're seeing right now. So guys, you want to be very selective with where you're investing this year. Make sure you're in businesses that are B2B operators. Look at names. Again, I'm going to mention it. Stuff like EVO. Look at stuff like NVIDIA, right? That is just business to business. NVIDIA has no commercial consumers. They do have a gaming segment, but I think it's like $1.3 billion in revenue compared to like the $100 billion expected this year from their data center division. So you want to look for these type of operators, stuff like Evolution, anything in the semiconductor space as well. Now, looking at earnings for the rest of the week, guys, the big names are behind us. I can't really see anything impressive here on Friday, but we do have some pretty big data tomorrow. We have the PMIs, the composite PMIs and the manufacturing PMIs, as well as global services. And then we also have existing home sales year over year, month over month. Fed Jefferson is speaking, as well as the UMich sentiment. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.